Greetings, Jonathan Camarda, your humble CIO. So hopefully by the time you're watching this, you had fun with your friends, your family, your favorite football team won for your collegiate fans. And if not, the true beauty of this time of year is hope springs eternal. There's always next week. For you NFL fans, you can get lathered up Thursday. It's getting ready to start. That's not a recommendation, by the way. And always drive responsibly. So here we go from that standpoint. I'm watching your compliance. So here we go as far as where we are. Speaking of eternal, that's what it seems like since the Fed has lowered rates. So we know Jerry has that checkered flag going for September. How low will he go? All right, we're going to go limbo here. A lot of folks think that 50 basis points is on the table out of the talking heads you may hear. However, 25 basis points most likely. Two main reasons for that, folks. Number one, they don't want to seem too heavy-handed pre-election. There's already enough political banter out there. Number two, to give themselves more pliability to maneuver if the inflation looks a little bit more sticky, as we've had some mixed data. Although we all know the employment data, folks. The people that say that it's been a strong employment market, I don't know really what they're looking at, as I watch so many casts during the week, and they don't listen to my opines. But 800 and what is it, 81,000 revisions over the last 12 months. Certainly there's a pocket of weakness in there. Now, as we look at the macro level here, starting off, the market has been resilient this year without rate cuts thus far, right? Everyone was calling for what, 5, 6, 7, 8 cuts? We've had 0 cuts. And yet the market has stayed resilient, mostly because of strong corporate earnings. Now, we've seen this quarter a little bit of weakening there, a little bit mixed pictures between what they call earnings per share, what they've seen in the past, and then also looking forward to what they look at revenue guidance. A little bit of a mixed bag, and even some that have reported decently have gotten whacked, and others that have been mediocre got whacked harder. So it is a very interesting period. Now, as we look at the markets in general, we're seeing a widening, right? We see the S&P equal weighted breaking the all-time highs there, while the S&P 500 heavy in the Mag 7, right, which was outperforming equal weight early in the year, is actually just testing those mid-July highs after getting flushed out in early August. So we're seeing a broadening. NASDAQ as well trailing behind, as we've seen sector rotation the last few months. Real estate, utilities, financials, all outperforming technologies and as such. And if you weren't looking closely, you might not notice that, but certainly we have. And why is that, you may ask, beyond the broadening? Well, when you usually have rate cuts, right? What does well? Financials, they loan out at higher rates and pay lower rates. That's a pretty good spread there. Small caps are outperforming large caps again, as well as value outperforming growth. Your cyclical stocks outperforming. That tends to happen as rates go down as well. How far down will they go? We don't know, but we shall see. So from sectors, let's go to macro. Again, you see fixed income finally providing a buffer and some diversification. With pending rate cuts, of course, yields. The bond market's the smartest guy and gal in the room. So generally, ahead of time, the last few months have been pretty attractive to find multiple duration destinations there, as you might have seen in active capital preservation in your conservative accounts. And then, of course, gold. You've seen an infusion of gold, both on an individual equity level and an ETF sector level, depending on the strategy you're in. What does this mean? Well, we still got the seatbelt tight, folks. September into October is the most volatile time historically. No pun intended. It is hurricane season and it's football season. Either way, you got to watch and keep your head on a 360 lazy Susan Linda Blair swivel to make sure that you're always aware of your location. And so, therefore, we are still, for aggressive clients, pretty heavily weighted in opportunistic allocations. For new clients coming in, you'll notice that even if we made some maneuvers protecting from the August swoon, reallocated to get you involved in some of the upside, didn't want to put all that powder in. If we get blasted or at least a strong pullback in September, you have dry powder to invest at lower levels, or gives you that first chance to back up by the door there if things do get out of control to the downside. So we shall see. It will be an interesting month of September. We will stay eternally vigilant. You stay eternally frosty. Again, drive responsibly out there. Even if your team didn't win, be careful. They got Uber now. That's not a stock recommendation. Compliance, don't need the memo. Till next time, I'll stay cool as a cucumber. You stay cooler than the other side of the pillow, and together we'll have ice water running through our veins. Jonathan Camarda, truly a pleasure to serve, and we always welcome your thoughts, always.